Yo, what up, man? Prof again. You already know what it is. FTSW from the streets to Wall Street. You guys are basically welcome to another video. In this video, I'm gonna be doing a trade breakdown of several trades that played out last month. Last month seemed to be a very rough month for a lot of traders, including myself. And irrespective of the fact that the month was kind of crazy and the price action wasn't really moving the greatest, I still want to believe that the strategy hasn't changed, the system hasn't changed, the approach to trading the markets is basically the same. Not that it's not evolving. You don't want to be changing something that works. So even in times of crazy uncertainty, even in times where the price action is moving in a way that's unfamiliar to a lot of traders, I want to show you guys how sticking to the plan will save you from a lot of losses in the market. Now, unfortunately, I was tagged out of the market because the manipulations were kind of crazy. However, I want to show you that sticking to the plan can give you very good trades, and at the end of the day, you can definitely make money even when the market is very uncertain, based on geopolitical tensions, based on some type of fundamental activity. Because last week was NFP, you can still get good trades because the market is the market, and like I always say in my videos, price action is presented to us in form of structure. So therefore, structure is one of the most important things that you should be learning, that you should be studying, that you should be looking at in the financial market. Why? Because no matter the strategy that you trade, market structure is market structure. We can unanimously agree that a bullish market is a market that creates higher high, higher low, and a bearish market is a market that creates lower highs and lower lows. Okay, this is something that is generally accepted as a fact in the financial market, or as financial market traders, we can generally accept this as a fact regardless of the strategies that we trade. This is a fact. So in this particular video, I want to be showing you guys two trades, okay, one on Gbpusd and the other on Eurusd, just because they have similar price action. I just want to show you guys two trades. I think this is going to be the trade of the week for last week. Maybe I'm going to touch on gold if I have enough time, but of course I don't want to make the video too long because people's attention span can be very short. Okay, a lot of the times people don't watch the video to the very end to milk out all of the juice and all of the gems that's stored in these videos. Okay, I want to encourage you to watch the video till the very end. It's going to really make a lot more sense when you do that, because I'm going to be giving you guys context on different pairs in terms of the structure, in terms of liquidity, in terms of just like the general way price action is presented in these pairs, from pair to pair, from asset class to asset class, in this case from currency to commodity, talking about Eurusd, Gbpusd, and gold, which is a commodity. Without any further ado, I'm going to be jumping into the chart right now, and I really hope you guys learn from this video. If you're new here, you want to subscribe to the channel, you want to like this video, and of course leave a comment, tell me exactly what you learned in this video. And of course you can make requests for future things that you want to see on the channel, whether it be a chart breakdown, whether it be live market analysis, because I'm very open to doing that. Let's jump into the charts, man. Let's have some fun. It's been a while since I did a trade breakdown video like this. I'm really hoping that you guys enjoy this video and learn something from this particular video as well, man. Just like I said in the intro, I want to show you guys these two trades on Eurusd and Gbpusd, guys. All right, so of course we know we have to do some type of top-down analysis, right? Very important that we do some type of top-down analysis. And I'm going to be starting here on the daily time frame. So already I want to believe that you can see exactly where this trade came from. Basically what we can see here is the fact that the market, okay, reacted from a breaker level, right? This is something that I teach within the GPS Forex trading blueprints. Of course, if you want a copy of that, you can click in the description of this video and purchase the course. There's a lot more detail into breaker levels, order blocks, demand and supply, things of that nature within the course. This is only a trade breakdown. I'm just trying to simplify trading for you guys, at least for the most part. All right, so one thing I like to pride myself in is the fact that I make trading understandable for at least a layman. Okay, I bring concepts that are very complex, concepts that are very technical, and I make them very easy for people to understand, very approachable. Okay, Because a lot of people see these concepts and just have this feeling like, man, this thing must be very, very difficult. It must be very, very technical. But to be honest, that might not be the case. Okay. It depends on how you're being taught and how these things are being explained to you. All right. So in this particular example, these trades came from the breaker level, having been on a higher time frame bearish market. So what do I mean by that? I simply mean that on the higher time frame, the market was bearish, right? So here we can see on the daily time frame. I'm not really going to go into the entire top-down analysis and building the storyline and things of that nature, because that will make this video very, very long. All right. But I just want to show you guys clearly here that the market was in a downtrend. Now, what do we mean when we say the market is in a downtrend, or when we say the market is bearish? It simply means the market is pushing to the downside, right? So price itself is reducing, price is coming down. Okay, you can see how I'm trying to bring this down to everyday language that anybody can understand. Okay, when something is dropping, there's a countdown from 10, 9, 8, 7, 6, 5, 4, things of that nature. That means there's a descent in price, right? Price itself, a lot of people forget that we're in a marketplace and we're talking about prices. Price itself is what is descending. Okay, but in the descent of price, it seems to create some type of structure, and we can recognize that structure, by the, for lack of better words, diagram that I'm drawing right now, where we have a push to the downside with this area being a high, this area being a low. We have a pull back to the upside. In this case, the buyers are trying to push the market back up to see if they can change the trend. But if the buyers are not sufficient enough, or if the buy orders are not sufficient enough to overturn the trend, guess what's going to happen? The market is going to keep pushing to the downside. So in a downtrending market, we're going to be having markets that are breaking structural levels to the downside. Now, hold that thought for a minute. We have broken structure to the downside around this area here, but there exists a possibility whereby the market creates a low and it doesn't break structure to the downside. In that case, we're going to be having an equal low, which means that the market reacted from some type of support area around this area here and then pushes back into the upside, where we're going to be having a double bottom, all right, or equal lows, right? Now, for the fact that the market was able to take out that support level, this support level now becomes a resistance level, whereby we can expect that the market can pull back into and continue to the downside. We call this particular level a breaker level or a breaker zone. Okay, so these trades came from the breaker level and or the breaker zone, depending on what's comfortable for you to use. I'm going to show you guys how to draw the breaker level and of course how to draw your breaker zones. Now, how do we trade essentially from the breaker zone? We want to wait for the market to react off of the breaker zone, and if the market decides that it's going to change character as a result of that reaction from the breaker zone, then we're going to be entering a trade from that breaker zone. Now, what do I mean by that? This is what I mean exactly. So when the market is bearish, we have a high creates a low creates a high, and we have a break of structure to the downside, creating a breaker level or a breaker zone around this area here. And of course, sometimes we might have resistance level in the form of order blocks that are coming from these areas here. All right. So how exactly do we act in the market? How exactly do we, take a trade off the breaker zone if the market is going to provide us a trade from the breaker zone? This is exactly how it's done. All right. When the market is pulling back, it creates another type of structure on the bullish side. Remember, this is a bullish pullback. All right, or a bullish retracement. In this case, we are in a downtrend. As soon as the market reacts off of the breaker, once we have a change of character to the downside as a result of that breaker, we're going to be having a new order block or a new resistance level where we can expect that the market can get to before it sells to the downside. Okay, I want you guys to pay attention to the structural representation of the concepts that I'm explaining in this particular video, because it's going to look like clockwork when we go to the market and start to see that the exact structural presentation that I'm doing right now is actually what happened in the market. Okay, trading can be very, very easy if you know exactly what you're doing, and of course you need to be taught in the right way. Okay, you need structured learning, and that's the reason why I'm here breaking down the charts for you guys in a very, very structured manner. Now what I like to do is, first of all, explain the conceptual view before I start to explain things in the market per se. So having explained all of this, let's jump back into the market and let's start to break down the market, how exactly this came to be. So the first thing you want to do when you're trying to analyze the market is that you want to determine what trend we are in. So already in this case, we have determined that we are in a downtrend. Okay, and how do we know that we are in a downtrend? We have the market creating series of lower lows and lower highs all the way from here. We have this as a high. We have this area here as a low. We have this area here as a high. And of course, we have had a break of structure to the downside right here. All right. So we had a break of structure to the downside right here. And of course, just like I said, we have breaker levels and we have order blocks, right? So what I'm going to do right now is I'm going to double click on this. I don't want it to be too visible, so it's not going to be confusing us when we jump down to lower time frame. So I'm going to reduce the opacity to something like a 30. Let's see. There's a 30 or like a 18. Okay. I believe this is not too opaque. It's not going to distract us when we go down to lower time frame. So on the higher time frame, this is the structure that we see on the higher time frame. Now, of course, when it comes to breaking down market structure from time frame to time frame, we have internal and we have external market structure. Now, one thing you would notice is that on the internal market structure, on this pullback leg, we have low, low created high, high created low, and then low created this high. So we have internal market structure on this pullback leg. That's very, very important. Okay, we have internal market structure on that pullback leg, which is a low, a high, a low, and a high. So our external break of structure is coming from this area around here. And of course, our external breaker will be coming from that area around there. All right. Whereas our internal breaker, okay, I'm going to remove this because I didn't derive this from this particular time frame. But when we go to the time frame where I got that, you're going to see how that is important. All right. On the internal structure of the market, however, we have internal breaker around this area here. So we have two areas of breaker where we can expect that this market can pull back to. Okay, the market can pull back to either this breaker and push to the downside, or the market can pull back to this breaker and push to the downside. Now, notice how when the market pulled back to the breaker the first time, there was a reaction from the breaker and there was a push to the downside. Now, as a lower time frame trader, after that reaction, of course, you can get good trades from that particular area there. But at the end of the day, the market pierced back into that area before the main sell kicked in. But again, this is about the breaker levels. Now, in this particular example, the market decided to invalidate the external breaker and decided to use the internal breaker. All right. So because of that, I don't want to make the video too long. I'm going to remove this. I'm going to remove this. And I'm going to remove all of this, right? So I want to clean up my chart a little bit because I don't want this to be very, very messy. Okay. So what we are looking at is on the external structure of the market, we had high, we have low, we have high, then we have low. Now on the internal structure, still on this same time frame, we have low, we have high, we have low, and then we have high. I'm talking about internal structure of this particular pullback leg, which led to the breaker on the internal structure. But because we are still on the higher time frame, we're going to treat this as important because these are higher time frame levels. So irrespective of the fact that it might be an internal level, it is still on the higher time frame. So therefore, it is a higher time frame level. All right. Now, on the daily time frame, we know exactly where we should be looking at in terms of selling the market. We have this breaker area around this area here, and we had this order block area or this resistance and or supply area around here. All right, so possibilities are the market can react from the breaker or the market can react from the order block, just like I explained earlier. In this case, this is going to be a supply level, okay, because this is a bearish order block, so that's going to be a supply level. All right, supply is equal to resistance while demand is equals to support. All right, it's just terminologies, man. You don't really have to confuse yourself about all of that. So anyways, this is our daily supply level and we have our daily breaker. Now breaking down the market from higher time frame to lower time frame, from the daily time frame we're going to jump straight into the 4-hour time frame. Now remember, like I told you guys, sometimes we can use 141, which is the daily, the 4-hour and the 1-hour time frame. Sometimes we can use 182, which is the daily, the 8-hour and the 2-hour time frame. All right, so looking at this right now, on the 4-hour time frame, specifically on the internal structure, now I'm going to readjust all of these just because I don't want the charts to be looking too messy, guys. One thing is you don't want your charts to be looking too messy, so you're not going to get confused about your analysis when you keep jumping from time frame to time frame. All right, so this is going to be my structure on the higher time frame. Now on the 4-hour time frame, as we can see, this area here is a breaker zone on the 4-hour time frame. Okay, this candle here represents the breaker zone, and of course you can see the line that I put there on the daily time frame that represent the breaker level on the daily time frame. So what I'm trying to explain here is the fact that you can either use a line, okay, you can either use a simple line or the support candle or the support order block, all right, or the support zone that was there at the time can be your entire breaker zone. Okay, so you can either use a line or you can either draw the entire breaker zone. Right here you can see the orange line signifies the breaker level on the daily time frame, but now that I've come to the 4-hour time frame, I want to know exactly where I'm marking out in the market. So I've marked out the 4-hour breaker zone, and again you can see how the market pierced into the 4-hour breaker zone and we had that massive sell to the downside after confirmation, of course. All right, so on the 4-hour we had several levels on the internal structure of the market where the market can definitely get to before it pushes to the downside. Now of course on the daily time frame around here we have 4-hour levels inside of that daily level. Okay, 4-hour levels around this area here, that will be the extreme level of supply. Okay, extreme level of supply, while we have a few decisional levels, of course, inside the daily time frame as well. The market could have reacted from any one of these levels. Again, we don't choose where the market reacts for the market. The market does whatever it wants, and all we have to do is to react to whatever the market does. Now again, just like I explained in the structural conceptualization of the concepts, we can see that we have a pullback, a bullish pullback once again to the upside, talking about this high, this low, and at this time the market seemed to be in a range. Okay, the market pierced into the breaker level around this area here, but for the market to move from this area here all the way here, I want to believe that if we zoom in, we can see some type of, again, internal structure of that leg, suggesting that the market did high, low, and high. Okay, so that's internal structure of that particular leg. So once again, as soon as the market hits this area of breaker around this area here, we had a change of character to the downside. This one is very, very clear and very, very self-explanatory. Okay, the one I decided to trade was GBPUSD, and to be honest, I feel like I chose the wrong pair, because if I would have traded Euro USD, this was a massive trade to the downside, but I just wasn't focused on Euro USD. I was focused on GBPUSD. All right, so the market hit the breaker, and for this one I really don't even have to go down to the 1-hour time frame or whatever, because it's so clear on the 4-hour time frame. You can see how structure moved from here, low, high, low. We reacted from the breaker level coming from the daily time frame, at the same time reacting from the breaker level coming from the 4-hour time frame. So there's convergence there, there's some type of confluence there, whereby the daily is saying, of course, you can sell from this level, and the 4-hour is also saying you can sell from that level. Right now, for the fact that the daily and the 4-hour are both higher time frames, it gives us enough reason to actually take a sell from that level, especially when we had a massive rejection of the breaker level that caused a change of character to the downside. Now, again, once again, guys, I'm emphasizing on this because a lot of people don't understand the concept of market structure. Market structure is not so linear, right? Market structure is not so simple, right? This leg of price from this high to this low can have internal structure like this, and then this area here aligned with the breaker level is also aligned with some type of internal order block that gives us more reasons to be selling from this level, and that's exactly what's going on in the market right now. Again, you can see internal structure of this leg. If I zoom in a little bit and draw out the path of market structure, you can see that from this high we had low, we had high before we had that break of structure to the downside, and this will be our change of character. Okay, CHOCH, of course, higher time frame change of character. Now, mind you, a lot of people would argue that this is not a break of structure to the downside, but again, a break of structure occurs when a price level goes above another price level. As soon as it does that, that is a break of structure, regardless of the fact that it is a wick. All right, because what you can see as a long wick on the 4-hour time frame, okay, all of this is a wick on the 4-hour time frame. This could be an entire body of a candle on the lower time frame, maybe on the 1-hour time frame, maybe on the 30 minutes time frame, maybe even on the 15 minutes time frame. So what you might see as a wick and not a break of structure on the 4-hour time frame can be a clear break of structure on another time frame, and that's the reason why we like to do something called multi-time frame analysis. Again, more of this in the GPS Forex trading blueprint. If you want access to that, click on the link in the description below to get access to the course. All right, now, having had all of this reaction that pushed the market, caused this break of structure to the downside in the form of a change of character to the downside, we have this internal structure where we have internal area of supply. That is exactly where the trade came from. Like I said, for this one, I'm not going to go down from the 4-hour time frame. All right, as soon as we have this, then we have market structure that we can now work with. And of course, when we're looking to sell the market, all we want to see is low, high, break of structure to the downside, and we can expect the market to pull back to the supply level like so and sell to the downside. And that's exactly what happened here. But again, remember that all of this is only possible because the market reacted from the breaker, and as a result of that reaction from the breaker, we had a change of character to the downside, and we had market structure present a very clean downtrend, and this is the trade. Okay, all of this happened in the month of May. Who am I to say May was a good month when every other trader is saying May was a bad month? Now, even on the 4-hour time frame, this delivered a 1:6 risk to reward trade. All right, and of course, this is not the only trade that played out from that particular level. You can see the money transfer all the way from here. From here, money was transferred to here. From here, money was transferred to here. After this break of structure, okay, now we have another break of structure to the downside, leading the market to pull back into this area of supply and sell to the downside. So this was another trade, right? This was another trade that played out on Euro USD for a sell. Now, mind you, these trades were kind of tricky to hold. You can see how the market, came back into the area of the entry. So if you would have been break even on this trade, chances are this market would have taken you out at break even. But again, this is the concept playing out here. So we have 1:6 risk to reward trade playing out here, and we have another 1:6 risk to reward trade playing out here. So altogether we have a 12-hour on these trades. Now, if I'm going to be conservative and set my take profit around this area here, or maybe, so this could be an area of take profit. This could be another area of take profit as well around this area here. So if I'm going to be conservative and not drag my take profit all the way down, bringing the take profit around this area here, that's a 1.8. Sorry, nope, that's not correct. With the stop loss around this area here, that's a 1 to 3 risk to reward trade. And with the stop loss around this area here, that will be a 1 to 2.7 risk to reward trade. And if we're going to take the, this target here, then we have a 1:3.8 risk to reward trade, almost a 1:4 risk to reward trade, and we have a 1:3 risk to reward trade. So altogether, this is roughly about a 7%, winning trades if we combine the two of them. And guys, you can see how simple this is. The only thing there is that sometimes while you are holding a trade and maybe you have broken even on this trade, the market can come back, stop you out at break even, basically manipulating you out of your position before the drop. And again, this drop was caused by the NFP from last week. I really hope you guys understand this. It's very, very simple, guys. So this is the trade from Euro USD. You can see how the market reacted off the breaker. As a result, there was a change of character, and of course, it's all a matter of following market structure and catching your trades to the downside. Now, in this particular example, I'm not refining these levels down to lower time frames, but mind you, all of these 4-hour supply levels can be refined down to lower time frames, and you can get smaller areas of risk and larger areas of rewards based off of the fact that you'll be taking the trades after even lower time frame confirmation. But just to keep things plain and to keep things simple, and I believe this will favor swing traders as well, because this is the higher time frame. You don't need to be second guessing things on the lower time frame. Once you see your order block, once you see your areas where you want to be taking your trades from, all you have to do is execute and wait to allow the market play out and decide whether you're going to have a winning trade and or a losing trade. Whatever the case may be, you should be able to not expect a particular outcome, but expect the market to move in either direction. And of course, the market can hit your take profit or stop loss. That's the reason why you want to be using good risk management, because at the end of the day, no trade is guaranteed in the market. All right, no one single trade is guaranteed, but if your risk is constant, anytime you lose a trade, you're losing a particular amount of money, and anytime you win a trade, of course, your wins are multiplied, because that's the way the market works. This is the concept of risk to reward ratio. All right, so that's all we can take on Euro USD. Very, very quickly, I want to touch on GBP USD. Similar price action. Let's go to the daily time frame. Just like you can see here, I don't want to touch on this for too long, but again, you can see market structure on the daily time frame. We are having high, low, high, and a break of structure to the downside. Now, mind you, look at the buying side of things, man. So when we had this low, when we had this high and this low, there was a break of structure to the upside, creating a breaker level around this area here. Now, look what happened when the market pulled back into that breaker level. Boom, reaction from the breaker level. That's to tell you how much, the breaker level is very, very efficient. Okay, on the buying side, the market is buying from the breaker, and on the selling side, the market is selling from the breaker around this area here. You can see reaction from the breaker and selling to the downside. Now, on the daily time frame, because I'm more focused on the sell trade in this particular example, the market is reacting from the daily breaker level, on the sell side. Now, going to the 4-hour time frame, again, you can see how internal market structure is aligned. Okay, internal market structure is aligned with that area right there. So I'm going to make this a little bit clean. I don't want to confuse you guys having come to the 4-hour time frame. Okay, I want to make this a little bit cleaner on the 4-hour time frame. But you can see how internal market structure, right? Around this area of the daily breaker, we can see how internal market structure is aligned with that area there. Again, this is the structure coming from the higher time frame. On the 4-hour time frame, look at the internal market structure, guys. So we have high, we have low, we have high, and then we have low, we have high, and of course we have break of structure to the downside. Okay, internal break of structure to the downside around this area here, meaning that this is going to be a supply level. Now, the way I marked this particular supply level was, I can see all of these candles here are bullish candles, so I nested the candles. Okay, there's something we call nested candles, and this is one thing that a lot of new traders might not know, but a lot of OG traders might know this. Or you can go to the 8-hour time frame. Okay, it basically combines two candles together, and you can use two candles as one particular zone. Again, on the 4-hour time frame, you can see what I did there. I took the last two candles as opposed to taking the very last candle. And the reason is because I'm reading the intention of the market. I'm just not looking at the candles. So again, this is the trade I actually executed on, but unfortunately, I was manipulated out of my position. So again, as soon as the market reacted from this area here, you now want to be looking at this side of the market around this area here. Okay, now looking at this, we had a reaction, big push to the downside that caused a break of structure categorized as a change of character. So again, look at the structure of the bullish market. Sorry, guys. Look at the structure of the bullish market. From this low, we have low, we have high, we have low, and of course we have high. Now you can see the market came all the way down here, but I want to argue that there's still more internal market structure on this last leg. So from here we have some type of high, some type of low before we had this high, maybe even more internal structure there. But again, this is basically a change of character. You can see how the market invalidated all of these areas of demand, giving us intention that it wanted to go lower. Okay, now, as soon as I saw this, I knew 100% that the market was going to pull back into a certain level before it pushes to the downside. Now, technically, if I go to the 8-hour time frame, this will be my 8-hour supply level. And you can see how the market never got to that level. But this is the beauty of internal and external market structure, because this particular trade came from the internal market structure. So where we couldn't see the market reacting from the 8-hour time frame after the change of character, as a result of a reaction from the breaker, if we go to the 1-hour time frame, guys, you can see internal market structure. Okay, internal market structure suggested that we had a level here where the market would hit and of course push to the downside. So this was exactly where my trade came from. You want to try to not get confused, because I understand how all of these can get very, very confusing. Please try to not get confused. All right. So I held this trade for a while. Honestly, held this trade for a while. But at the end of the day, the market still ended up coming back to sweep me out of my position. So my trade basically came from this area around here. Don't even get me started on liquidity, man, because I don't look for liquidity. All I do is mark out my structure points and the market exposes the liquidity. So this was the relevant liquidity for this trade to play out. And this was exactly my trade, guys. But again, you can see how long I held the trade for, the market. This was where it took me out. All right. So I held the trade from the 29th of May all the way to the 1st of June, all the way to the 2nd of June, and as at the point where the market was, has done all of this, I entered from here. The market did this. I was still holding this trade, guys. I was still holding. And at this point, because of the fact that we had NFP coming out in the market, I was like, okay, it's time to break even my trade. So what I did was put my trade on break even, only for the market to manipulate me out of my position and then boom to the downside. Okay, eventually invalidating all of these demand levels. All right, so this is exactly how I trade. I trade using market structure for the most part. Okay, market structure is one of the most important things that you can learn. Again, this was my trade around this area here. And the market is the market. I can't really complain, even if I'm pained, even if I'm pissed. This gives me confidence that my strategy still works. Okay, and of course I can repeat this over and over again. Now on GBPUSD, having taken the trade from there, that would have been a clean 1:5 risk to reward trade, but unfortunately I was manipulated out of this position, and the market still went into the direction that I predicted or that I speculated at the end of the day. All right, so that was the trade on GBPUSD. Now just to wrap it up, I'm going to show you guys another one on gold. This one on gold is quite simple. I don't really want to go into too much. Again, the market reacted from this area here. Now, typically, I would expect the market to take all of these liquidity, because this is like a double top around this area here. So you can see this. This is like a double top, and the double top for us are areas of liquidity. So I was expecting the market to take this out before doing all of this to the downside. But again, the market is the market, guys. You don't really choose for the market. But as soon as we had this push to the upside, again, this is on gold. As soon as we have this push to the upside, this trend to the upside, because I believe you guys can see internal structure going up there. We had a change of character. The market pulled back into this area here. You can see break of structure again to the downside around this area here. The market pulled back, came into this area here, and then we started to create some type of downtrend. So we had low, we had high, and then we had low. This is a break of structure around this area here, leaving this candle for the entry, and that was the entry on gold, guys. So I want you guys to go back, take your time, back test all of these things that I've taught in this video. I want you to take everything that I'm teaching you guys with a grain of salt. I don't want you to just believe anything that I say. Even if I've taught a lot of people how to trade the financial market and they're doing very well for themselves, even if I have students even currently who are trading the financial market with the exact same concepts that I'm teaching you guys here, I want you guys to go back into the market and try as much as possible to backtest the market and have a feel for yourselves. Okay, investigate these things that I'm telling you or that I'm showing you in these presentations, and if you find anything useful, come back and leave a comment in this particular video. And of course, leave a comment telling me what you want to learn next. Maybe I just might do a video for you the next time I show up on YouTube.